So imagine that you are 30 years old and you are so excited because you're gonna buy your first home. You're gonna be a homeowner. That's exciting. But you check the details and your house was built in the 90s. So you bite your fingernails about that for a little bit, but you look online and you see that the median age for a home being bought and sold today in America is 36 years old. So you think, okay, well, that's not too bad. With a 30-year mortgage, I'll finish paying this when I'm 60, just in time for retirement. And the house will be 66 years old. Maybe I can sell it for something better. You're on some rookie numbers, because what you actually need is a 50-year mortgage so that you're done paying it whenever you're 80 and the house is 86 years old. Because what is more American than spending half of your life paying for something you will never own? And if you thought that's as crazy as it gets, no, it gets a lot more dumb, because you're 30, right? So next year you're 31 and you just had your first child. You're a parent. You're so excited and you think, wait a minute, I'm a family man now. I'm gonna be a soccer mom. So you get a minivan, because that's what families do these days. Whenever that child is 15 years old, you will then be able to let them drive it, because they'll be getting their learner's permit, if that minivan is still even functional by that time. But let's break this down. The difference between a 30-year mortgage, a 50-year mortgage, a 5-year car loan, and a 15-year car loan, what that means for you and me, because this goes way more than just memes. This actually is more of the next generation being financially cornered. Maybe you've seen this post by President Trump where he's comparing himself to FDR popularizing the 30-year mortgage, but him popularizing the 50-year mortgage. Now, the premise is simple, making homeownership more affordable, and the math is simple, right? You stretch out the length of the loan, well, then the payment comes down, which is technically true, but there's one key piece of information that is missing from that whole argument. And that is that with longer loans, interest rate on the loans tend to be higher. Now we see this with the 15-year loan. Right now, the average on a 15-year home loan is about 5%. A 30-year is about 6%. So a 50-year, you could probably expect like a 7% interest rate. So let's see this image to get a good example of what the difference actually is. Here in this image, we see a $500,000 house, 20% down with 6% interest. Well, your payment is about $2,398 a month. Now, let's make it more realistic with the 50-year mortgage with a 7% interest rate. And you can see that your payment has now came down to a grand total of $2,406. Wait a minute, that's not down, that's up. That's an increase of $8. And you've probably seen this example online going around because it's the one that makes the most sense here. But what's actually going on is that now with the 50-year mortgage, you're paying a total of $1.44 million for that same house. It's like an extra $580,000. This is what economists call payment illusion, because it makes something seem more affordable, but in reality, you're stretching out your misery over a longer period of time. And sure, some people might say, well, I'll just pay it off early. I'll make extra payments and pay it off early, not 50 years. And while yes, that's technically true as well, the amortization schedule is what kills all those theories, I guess, because this is kind of what everyone has in mind when they think that for the average homeowner, buyer, whatever. In this image, we can see an amortization schedule where you're paying principal and interest at somewhat of an equal rate, equal amount, and you see your balance going down over time. So when you make extra payments, it'll bring that principal balance down quicker. But that's not what's actually going on here. What's actually going on is this other principal versus interest chart by Chase Mortgage, where here in this principal mortgage interest chart, we can see that in reality, what happens is in the amortization schedule, each bar represents like a payment you would make. But the little purple piece on the bottom is the principal you're paying. And the interest you're paying is that big, longer red on the top. So every payment is divided between principal and interest. But the way that this goes is that over time, as you get into the last 20 years or so, more of your payments start going towards principal than interest. So in reality, whenever you're 15 years into your mortgage, you're not actually 50% down and paying your house. You are 50% down in the loan, but not the home. So if you are to sell it at the 15-year mark, where you won't actually get 50% of the value that you sold the home for, you will get closer to about 38% of the home's value that you sell it for. So if you bring this to the new reality of a 50-year mortgage, well, over the course of 10 years of you paying that monthly payment towards your home, of the 50-year loan, where you won't actually get 50% of the value that you sold the home for. You will get closer to about 38% of the home value that you sell it for. So if you bring this to the new reality of a 50-year mortgage, well, over the course of 10 years of you paying that monthly payment towards your home of the 50-year loan, you will own about 10% of your home. So if you put a 10% down payment, which normally is 20, but let's say you put 10% down payment, you pay it for 10 hard years of you working hard. Then you actually now own 20% of the house. You don't even own anything else more, which wasn't all that great with the 30-year mortgage anyways, but now with the 50-year mortgage, kind of makes it obsolete. It's almost like you rented your home from whatever bank you got it for. And not to mention that this usually results in higher prices in the homes from the home builders. They can put more of a price on their house, which of course will not be double, but they will increment it slightly higher than what they did before, because now the budgets just look bigger. Now, try to be a little fair with how this might work is some people are bringing up the argument that, well, the Trump administration might subsidize some of the interest points. So if it normally would have been a 7% interest loan on the 50-year mortgage, they might subsidize like 3% or something like that, which I guess would also make sense and make it a better deal. That doesn't change the fact that you're locked in for 50 years on a mortgage. And if the government does subsidize percentage points, well, that's just gonna contribute to increased housing prices. And we have a bigger issue, a whole other thing there. But to me, that isn't even the biggest issue going on here that's going to affect the general population of America. If not the 15-year car loan, that is way worse. But how could it be way worse if it's less money than a 50-year mortgage? Well, I'll tell you why. It's because a 15-year car loan is more accessible to your average everyday American that might not have 20% for a down payment or whatever for a down payment on a home. Maybe they don't have an income that'll even qualify for that. But a 15-year car loan, with how predatory dealerships are, that is going to spell disaster, and it'll lock a bunch of people up that maybe they were going to one day buy a home, but they locked themselves into some 15-year car loan at 20% interest, and now they're going to pay that off at super high amounts, and then the car is going to break down. That's going to be a disaster. And here is a picture that we can go through of what it would look like to actually get a 15-year car loan. In this image, we see something that is somewhat normal of a car loan in today's market. So if we look at it, a normal 5-year, $50,000 car loan at 5% interest, you'll pay about $754 a month. I mean, I still think that's so high, but whatever, it's reasonable in today's economy. You pay $5,000 in interest total. All right, square deal, done. But now let's make that into a 15-year car loan. Same $50,000 price, but with 3 times the amount of time period. From a 5-year to a 15-year, we could expect a 3 times jump in the interest at 15%, which of course none of this is solid or concrete. It's just theories that I'm crafting because these don't actually exist yet. But let's just jump into the example just to see what. So looking at the image, a 15-year car loan at 15% interest, 180 months, your payment drops to $559 a month. So you might say, wow, I'm saving about $200 a month in my payments, but that's not savings at all, because instead of 60 months, you have 180 months of that. So now you're paying closer to $60,000 in interest. Now you might say 15% was way too astronomical of a number, and maybe it is. I don't know. Like, if this ever happens, we will see what it actually be. But even if it was at 5%, you need to keep in mind you're going to be paying a lot more interest anyway on the same vehicle. And in 15 years, we saw the amortization schedule for homes. It's the same situation for cars. So if you have the car for 5 years and it still hasn't broke down, you want to sell it, well, you don't actually own 33% of that car yet. You own closer to 15 or 20. So you're not actually getting your dollar's worth that you're working so hard for. Now, what car will actually last you 15 years? And what car do you want to be paying off for 15 years? What's happening here is subtle, but it's there. We're normalizing lifetime debt. Instead of actually solving the issues, the wage stagnation, the housing supply, all that mess, we're just gonna extend the loan. And then here in 50 years, whenever your mortgage is done, maybe your kid can take out a 40-year car loan. And that's the scary part. We're building an economy where ownership is just a feeling. You can own a car, you can own a phone, own a home, as long as you're okay with never actually paying it off. But the ultimate price has already been paid by Jesus Christ. You should definitely look him up, look into him. And you should also check out these other videos on the channel if you're interested in other finance topics, and hit the subscribe button, hit the like button. See y'all later.